Good afternoon and welcome to BizTech's Asian Midday Market Watch. Our guest today is Gabriel Yap, Executive Chairman of GCP Global. Gabriel, as always, great to have you on the show on Friday.
Happy Friday, Brian.
Now, before we get your insights, let's take a look at how cryptocurrencies are performing. We've got Bitcoin at 47,180.3 now. It's up 7.05%. Ethereum is at 3,227.41, also up sharply 8.67%. Now, if we look at regional markets, we've got Bursa Malaysia, which is up 0.41% at 1,521.14. The SGX is at 3,110.72. It's also up 0.77%. Across regional markets, the picture is not so rosy. The Nikkei is at 27,056. It's down 0.82%. The Shanghai Composite is down 1.66% at 3,408.15. The Hang Seng is down 2.28% at 24,739.6. Rounding up the numbers, we've got the ASX 200, which is at 7,468.8. It's down it's up 0.07%. Now, Gabriel, what's the reason for the rather negative sentiment in China today?
Well, for China itself, it's still very much the uncertainty arising from the various slew of regulations that's still coming out on the tech sector, platform sector, the education sector. Today's, or rather in this week, when Tencent, one of the major companies in China, reported results, they have guided that on the regulation side, do expect to see some more rulings pertaining to some of the regulations and the curbs. Of course, Tencent basically have also assuaged Tencent shareholders' fears that essentially they think that they are able to comply with what Beijing is actually dishing out after 2 decades of non-regulation within the internet sector.
Yeah, so just to give the audience a perspective of the losses itself, Meituan was down 7.11% today, Alibaba 2.16%, JD.com 3.08%, and even the Shenzhen and Shanghai Composite, the Shenzhen component stocks were even down 2.18%. The key thing, however, out of China in terms of data is the 1-year loan prime rate and the 5-year rate were both left unchanged, which is obviously a good sign because David, market observers were concerned that they would perhaps have to ease it.
Actually, I didn't agree to that because I thought that this year, if you look at the GDP growth forecast, this is for the very first time this year in the last 10 years, that they're able to meet the GDP forecast. And in this case, they were guiding previously 6.5%. It's quite likely that they will come in above that. And basically, that has been suggested. That's why the regulators were able to do their job on the tech sector regulation, which of course is likely to crimp earnings in the 3rd quarter and 4th quarter. But despite of that, many of the economists are still saying that, look, they should be able to notch in GDP numbers above 6 to 6.5% as previously guided under the 14 5-year plans.
Now, Gabriel, I want to look at overall in terms of the S&P 500. Now, essentially, you've had 109 days. I mean, it's at record levels now, 109 days consecutively without a big pullback. Could you just give us your perspective as an investor in terms of what your view on this is?
Right, Bram, as we said earlier, it's as of last night with S&P closing, the S&P has been on a rage. It's up for the 199 market days. So tonight, if we close well, we are on a 200-day uptrend where the S&P has been surging, recording new highs. In fact, within this year alone, the S&P as of last night notched up is 49 higher highs, which means essentially that the bull market at 4,004 continued to rage on. I think essentially what this means, of course, is that in the last well, in this century alone, there has been like 8 episodes in which the S&P have actually gone up more than 200.
Sorry, Gabriel, we've lost you.
Market sessions without a more do you hear me now? Like I said earlier, there have only been a couple of sessions, something in the region of 8 to 10 occasions in this particular century, or rather last century. That means for the last 120 years, therefore, that you actually have the S&P going up by more than 200 days without a 5% pullback. Now, on the skeptical side, you can actually say, wow, it's gone up so much so fast, without a 5% pullback, therefore you should be cautious. But on the other hand, if you are risk inclined, you will notice that the last time in which the S&P went up like more than 200 days without a 5% pullback, that was between the episode of the 2018, all the way permeating up to 2019. The S&P went up to do like 404 days of market moving up without 5% pullback. So by the time they pull back, essentially, if you had stayed on the sideline, you would have missed all the gains then and there.
Now, do you then subscribe to the view then that the peak growth narrative, essentially that we're at a stage where we're at peak growth right now, and the market is basically just about to turn?
Essentially, the first and foremost, I do not subscribe to the peak theory, because the peak is only well known on hindsight, right? So essentially, most of the time, we look at reality and what the data tells us, and the reality now is this: for the longest time, the EPS upgrade in the S&P has been the sharpest. So like beginning of last year, we were looking at EPS on the S&P 500 at 172. But right now, the forecast is going at about 210 to 215, and this is based on market consensus only, which means that based on the PE of 22.5 times, essentially, while the PE is on the high side, but it does not connote the fact that it's actually near its peak. But of course, if you want to be skeptical, be cautious, you may want to say that, look, wait for the S&P to pull back a little before you jump in.
Okay, Gabriel, thank you very much for taking your time to be on the show and for your insights.
Thanks, Brian. Have a good weekend.
Now, we've been speaking to Gabriel Yap, Executive Chairman of GCP Global, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Please check out our LinkedIn and Facebook pages, as well as our website, www.biztech.asia. Please like and subscribe to our various platforms. Thank you very much for tuning in.